Hello my fellow investors, and welcome back to another earnings report as well as stock analysis video. And today guys, let's take a look at the company Occidental. They just had earnings today and they have massive news coming out based off of these earnings, honestly. And seeing that this is the GOAT, Warren Buffett's most favorite company, I would argue, in addition to that of Apple. I know he has been buying Occidental a lot whenever this thing dips. They can figure, you know what, might be a good time to take a look at their earnings, seeing that, well, they did miss. Just news head flash right now, they did miss, and they fell around 1% today. So with that said, let's get started with this analysis. So let's come over here and take a quick look at their earnings summary. Now this is not updated unfortunately, but we can see that their EPS normalized estimate was $1.83, EPS GAAP estimate $1.82, revenue estimate $8.21 billion, and you can see a lot of people were thinking this was going to miss, and they did. Occidental Petroleum non-GAAP EPS of $1.61 misses by 22 cents. Occidental Petroleum press releases Q4 non-GAAP EPS of $1.61 misses by 22 cents. And they also authorized something really awesome. Now you're seeing it right here. However, I do have the full news right here. Occidental Petroleum raises dividend by a whopping 38.5%, 18 cents, announced a $3 billion stock buyback plan. Absolutely insanity, guys. So let's see where this is going with that. Now let's come over here into their earnings report, and like always, this will be linked in the description below. And like I say in every single video, this is not financial advice, guys. Please do your own due diligence. This is why I give all the calculators up for free, as well as have all of these earnings press releases linked in the description below so you guys can read it. So that way you guys can make your own assumptions as to what you would like to invest in. Nonetheless though, let's take a look into these earnings. We got over here, Occidental announces fourth quarter 2022 results, announces enhanced shareholder return framework, including a $3 billion share buyback authorization and 38% increase to common dividend. Boom, first bullet, absolutely love it. Complete a $3 billion share repurchase. Wow, wait a minute. Oh, so they just, so they're doing it again. Complete a $3 billion share repurchase program with $562 million of repurchases in the fourth quarter, bringing a total share repurchases to 47.7 million shares. Wow, so they have bought back up decent amount, and apparently they're going to continue to do this. Another $3 billion, repaid $1.1 billion worth of debt, and retired $450 million worth of interest swaps during the fourth quarter, with total year debt repayments of over $10.5 billion, representing 37% of the total outstanding principal. All is sounding really good so far. OXY exceeded guidance with pre-tax earnings of $457 million, establishing record year pre-tax earnings of $2.5 billion. We got over here the cash flow, and we know that cash flow is everything. Cash flow from continuing operations, $4 billion, and cash flow from continuing operations before working capital of $4.1 billion. Capital spending of $1.5 billion, resulting in quarterly free cash flow before working capital of $2.6 billion. Earnings per diluted share of $1.74 and adjusted earnings per diluted share of $1.61. So you can see that they missed on both. Worldwide year improved reserves of 3.8 billion BOE with reserves replacement of 172%, and finding and development costs of $6.60 per BOE. All right, well, you know what? A lot of stuff there I technically did not understand. However, majority of the stuff that I did understand, it was all sounding really good. Now let's actually come over here and see what the CEO had to say. Quote, our fourth quarter 2022 performance capped a year of strong results, in which we set operational records across the US onshore, Gulf of Mexico, and international oil and gas businesses. While OxyChem delivered record earnings, said President and Chief Executive Officer Vicky Hullab, our operational success drove the financial achievements that enabled us to complete our $3 billion share repurchase program and deliver substantial balance sheet improvements. Our teams are well positioned to maintain this operational success as we continue to focus on delivering value for our shareholders in 2023 through our recently authorized $3 billion, another $3 billion share repurchase program, and a 38% increase in our sustainable dividend, which honestly guys, it really just wasn't that sustained. We're gonna take a look at that when we get into seeking alpha, but nonetheless though, that's all looking really good. Now I want to come over here into the numbers, however, because I do want to make some comparisons to that of 2021. Now we got over here, guys, when it comes into The reported income loss attributable to common shareholder, guys, we can see that in Q4 2021 it was $1.34 billion, and in Q4 2022 it was $1.7 billion. That's really massive. You can see even on the total year, oh my god, $1.5 billion in 2021, $12.5 billion in 2022. That's a massive jump. Coming down over here, guys, into what I would like to see the most, and that is the free cash flow. Continuing operations, we got operating cash flows before working capital. This is the non-GAAP. In Q4 of 2021, $3.87 billion. In Q4 2022, $4.11 billion. And even in the year, that was $11.7 billion to $18.14 billion. Absolutely crazy. Looking at the operating cash flows, we can see that this one was $10 billion in 2021, and 2022 was $16.8 billion. Guys, all of this is looking really solid. On top of them increasing the free cash flow, they're also lowering their debts. They're also repurchasing shares, $30 billion worth again, and they're issuing a massive dividend. So with that said, guys, let's come into the calculator to see if the current share price is looking like a buy. But before we do that, let's analyze this company from a much wider lens. We got the ticker symbol for OXY, market cap of $53.6 billion and a PE of 4.89 with a current share price of $58.96. Looking at this on the 1 year, they're up 34.83%. That's not surprising, seeing that, well, oil companies just been up massively this year. On the year to date, though, they're down 3.42%. 52-week range is $38.24 to $77.13. Now, looking at this current share price, guys, you can see that actually post-market, essentially when they released their earnings, they fell 1.24%, ended the day flat at 0.03%. But again, after earnings came out, they fell a significant amount, which I don't necessarily know why. I do know why. It's probably because they missed. However, they had so many other good things going for them, but just because they missed on analyst estimates, therefore this thing deserves to fall 1.24%. I personally do not think so. So again, this might serve itself as a pretty good buying opportunity, even though it is not at 52-week lows. Now, they do pay out a dividend of 72 cents, which, by the way, this is the updated one with the current 18 cents per share in quarterly dividends. However, on Seeking Alpha, they have not updated this. Current yield with a 13% is 0.88%. This is a payout ratio of 4.35%, a 5-year CAGR of negative 29.85% with one consecutive year of dividend payment. Now, if we come over here to the dividend history, if I had to guess, the reason why the 5-year CAGR is that low is because as of 2020, they cut it down to 1 penny. It was originally 79 cents, and then they cut it down to 1 penny. But you can see that they never really cut it. Well, sorry, they never really suspended it, but you can see that the cut was understandable in a way, obviously COVID related. So not surprising that as of today, they're going to bring it back up to 72 cents. Their ex-dividend date passed as of December 9th. Payout date was on January 17th of 2023, and they pay their dividends quarterly. Now, based off of this 72 cents in annual dividends per share and their current shares outstanding, they pay out $653.83 million in dividends every single year. And based off of their 5-year average free cash flow, after this is paid, they're still left with $4.3 billion, and even their last year's free cash flow is even more, $11.4 billion. These payout ratios are 5.44% for the last year's free cash flow and 13.24% for the 5-year average, meaning that they can 100% continue to increase this if they so wish to do so. Now, coming into the fundamentals, starting of course with the net income, we got 5 years ago of $4.13 billion to 1 year ago of $12.9 billion, essentially $13 billion, increase of 213%. Biggest outlier here, it is this 3-year ago value at negative $14.83 billion. But guys, this was a COVID related thing. I'm not really gonna blame them for it. However, what I don't understand is this negative $667 million 4 years ago. What caused this? I have no idea. Now, for this reason, guys, I'm gonna give this a 45%. Looking now at the free cash flow, we got 5 years ago of $2.7 billion to 1 year ago of $12 billion, increase of 346% with an average of $4.9 billion. Now, you can see something similar to that of the net income. 4 and 3 years ago, it came down slightly, going from what, 2.7 billion to then 1 billion to then 1.42 billion. So it's a little bit better than that of the net income, no negatives, but we do see a massive jump 3 to 2 years ago and another massive jump from 2 to 1 year ago. So for this reason, I'm going to give this a 55%. Looking now at the revenue, this one looks a lot better than the previous two. Less outliers overall, small dip 3 years ago, but nonetheless still looking really solid. 5 years ago of $17.8 billion to 1 year ago $36.3 billion, increase of 103.82%. Once again, the dip here happened in 3 years ago because again, COVID related, perfectly understandable, but you could see that it really wasn't much of a jump 2 years ago, right? Going from 21 billion to 26 billion. Big jump over here would be from 2 to 1 year ago, going from 26 to 36 billion. So that's why I'm giving this guys a 95%. Looking at the total assets minus total liabilities, this one is looking interesting because they have been in the positive in the past 5 years. We do see the drop from 3 years ago, right? They actually 4 years ago for them was massive, $34.2 billion, but they fell 3 years ago. COVID related probably, but then ever since they've been recovering very nicely. Average total assets, it is $81.3 billion. Average liabilities is $55.2 billion, and doing this difference we get $26.11 billion. I'm giving this guy a 70%. Looking now at the cash flow minus the liabilities, this one is not surprising that this is actually looking really good because we just read in the earnings report that they have been lowering their liabilities. That's like one thing that they're focusing on is their debts. So it's not surprising that their lowest point was 4 years ago at negative $72.95 billion. However, ever since then, guys, they have been decreasing this very consistently, like very consistently. So much that as of 1 year ago, they pretty much cut it in half. Negative $31.4 billion. Average cash flow minus the average total liabilities is negative $46.1 billion. I'm giving this guys a 90%. Looking at the shares outstanding, this one isn't looking too good. However, they just announced another $3 billion share buyback. And I'm willing to say that they're going to do it. However, the graph doesn't really show something good. 5 years ago of 749.4 million shares to today of 908.1 million shares, increase of 21.2%. And from the previous year to the current year, this is a decrease of 2.78%. You can see that their peak here was 2 years ago at 934.1 million shares, but ever since then they have been buying back, but that's only been one consecutive year. Now, I'm actually going to give this an 80%. And my reason being is because I think that they're going to do good when it comes into their $3 billion share buyback. So for all we know, if this is a really cheap company, right, based off of their fundamentals, if the board and CEO think that, you know what, this is looking like a really cheap company right now, we could buy back shares at this cheap valuation, then it's actually a good thing that they're buying back shares at this moment. So that's essentially why I'm giving this an 80%. And lastly, when it comes to the cash equivalents, they currently hold $1.23 billion with an average of $2.3 billion. When it comes to the overall grades, we gave the net income 45%, free cash flow 55%, revenue 95%, assets minus liabilities 70%, cash flow minus liabilities 90%, shares outstanding of 80%, for an overall grade of just barely passing 70%. I see why, guys, Warren Buffett likes this company. They have a lot of good fundamentals ahead of them, right? I think that if they are going to continue this massive amount of share buybacks as well as issuing a dividend, I think that they're going somewhere. I really do think that they are, and you can see that them lowering their debts, that's massive. I'm willing to buy into a company more if their cash flow stagnant, but their debts are like non-existent. That's amazing. So 70%, really, really solid. So now let's actually see if at the current share price of $58.96, this is looking like a buy. I am going to assume a revenue growth of 9, 12, and 15%. Based off of Seeking Alpha, we could see that the forward's estimated at 23. So I'm going to go with, once again, 9, 12, and 15. I think that's fairly conservative in my personal opinion. Now for the projected share buyback, we just read that they're planning to buy back $3 billion. Well, doing the math, guys, I get that $3 billion share buyback at around the price of $58. This is around 51.7 million shares that they're buying back. And if we divide that 51.7 million divided by the current shares outstanding of 908 million, we get a percent of around 5.7, 5.6. So let's say for the projected share buyback, 4, 5, and 6%. I think that's fair. And a required rate of return of 10%. We get target share prices, guys, of $63.52 to $78.92. Adjusting for debt, though, this comes down. But then again, they are solving this debt issue. well, it does come down regardless to $41.50 to $56.45. With a margin of safety of 5, 10, and 15%, we get $35.28 to $53.63. You can see that this has potential. This really does has potential. And of course, everything depends based off of this revenue. Let's say that you think that the revenue will be, I don't know, let's bring it up by 1. So let's say 12, let's say 15, and let's say 18%. Well, guys, at that point, you know, you got the median assumption adjusting for debt working for the current share price. So again, everything just depends as to what you believe this company will do. Me personally, though, with my assumptions, it's still looking really, really solid. Not adjusting for debt, it is an all-out buy. Adjusting for debt, it's very, very close. So I think this might be one where you just take the L on the small premium and you just go with it, right? I think that's just my personal opinion, but nonetheless, guys, every investment is the present value of all future cash flow. Please make your own due diligence. This is why all of this is available for free. All link in the description below, as well as the earnings report will be linked as well, because, well, guys, I want to help everybody make good financial investments. That's really it. And the best way that you do that is by not overpaying for growth. So this company is looking pretty good. However, make your own decision for yourself. Now let's come and take a look at this dividend. If we were to put in $5,725 with this current annual dividends per share of 72 cents, which again, it is, remember, that 38% increase, this nets us $69.91, almost $70 in annual dividends. Rather small, but again, I think they do have a lot of potential in the future. And lastly, let's come into their option chains, because this might be a company that, well, I mean, we just saw that they are seeming to be really, really good buy at around like this price. So the first thing that we need to point out, guys, is they have weekly expirations, which is really good. However, looking at the one expiring this Friday, March 3rd, we can see that there's actually a lot of good stuff going on here. For starters, well, if we wanted to sell a put, let's say that, you know, we wanted to sell this thing at around, you know, the $56 mark. Actually, let's just say like $53 mark, right? Highest assumption, 5% margin of safety. If we were to do that, guys, this would net us a put premium of $9. However, if we were to sell this for $55, which again, it is somewhat in line with this target share price adjusting for debt at the highest assumption, well, that is a premium, guys, of $30. That's not bad overall. And in fact, if we come over here to the March 10th one, for the same amount, actually, yeah, for the same amount, for $55, guys, that's $57. And for $56, $84 premium. Absolutely insane. And for the March 10th one, at $53 strike, $27. All looking really, really good. Now, when it comes to the calls, if you do have 100 shares of this thing, well, you guys can pretty much sell. You know what? You guys can pretty much make some very good premium on this, honestly. You could make $59 off of a 62 strike if you were to sell this call, just on premium alone. And that's on March 3rd. So that probability of that expiring is really, really high. And then coming on to the March 10th for the same strike of $62, guys, this premium now becomes $80. And if we do a $61 strike, this is $108 on the dot. That's absolutely insane. Really, really good solid premium. And on top of that, you have volume overall in both the call and the put side. So overall, when it comes to Occidental, this is looking like a good company to sell a couple puts in. Even if you don't want to buy it, you could always roll it afterwards and still get that massive, massive premium. All in all, when it comes to Occidental, I fully understand why Warren Buffett likes this company. It does have a lot of potential. I think this is one that he looked at and said, this is beat up. They do not deserve this. This is so much better than what, you know, the market's putting it at. I'm going to buy it. And he did buy it, and I think this is one that he's up a tremendous amount. But anyways, guys, that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link in the description below. So with that said, peace out, and I'll see you all in the next stock analysis video as well as earnings report.